I'm not sure that how you face this kind of like uncertainty, I would say. Yeah.
Well, I mean, like every other hedge fund, you cannot assume that the strategy that are currently profitable will remain profitable forever. There's always alpha decay due to competitive pressure, regime change, and so forth. I don't think that this compromise is unique to us, that we are trading strategy that have known to be profitable, but we are also exploring new techniques to discover new trading strategies. Every hedge fund is really in a constant state of innovation, just like a tech company. Okay. I mean, I shouldn't say every hedge fund, I should say every quant fund at least.
Alright, so welcome back to the new episode of Trader Podcast. Today we will commence this session with English. Normally we conduct in Mandarin speaking. Because today we have a very important person, and thanks for him to accept our invitation, and we can host this big guy. Alright, so some of you guys from our community maybe know him. So it's called Ernest P Chan. It's Dr. Ernest P Chan. So for those who don't know who he actually is a very true pioneer in quantitative trading, and especially in financial machine learning. So he's also the founder and CEO of PredictNow.ai, a cutting-edge platform that leverages AI to enhance investment decision making. And he also served as the founder and non-executive chairman of QTS Capital Management, a firm specializing in systematic trading strategies. He holds a PhD in physics from Cornell Universities and also a bachelor's degree from the University of Toronto. And also he have write some books, alright, so including quantitative trading, algorithmic trading, and machine trading. So today we will together explore more about like the quantitative trading theories. And because Dr. Ernest is more specialized in machine learning, so today we will talk about this in depth more. So let's welcome the one and only Dr. Chan. Yes.
Thank you for the very excellent introduction, Nansen. I'm very pleased to be here. It's my honor to appear on your podcast, and I'm excited to talk to your audience. The only addition to the intro is that I have recently published a new book called Generative AI for Trading and Asset Management. It's really about how to use this. And a lot of people, when they hear generative AI, they think of chatbots. It totally is not just about chatbots. It's about a whole new framework of applying machine learning to financial time series. So your audience might be interested to know that.
Alright, okay, cool. Maybe later we can talk more about this. To start, so maybe I just give some background introduction of mine. And actually I started manual trading since 2019, and I started in crypto markets till now. And I never trade in like traditional equity markets like forex, stocks, things like that. And I came across the idea of quant trading like from inspired by the guy called Jim Simons. I think every quant trading guy is like maybe inspired by him. I think, but at that time, 2020, when I tried to involve in quant trading, the first ever book or the first person I find is your name, because I tried to search on YouTube and then your name pop up. And I try to like find any like reading material, so I find that this is the first ever book. As you can see, there's like highlight, like notes. So I think the book is right. It's very practical. So I also strongly suggest you guys can like get it and read it yourself. And also like just now, Dr. Chen has also mentioned his new books. So definitely you guys can go check it out. But one thing I find that I will not say it's difficult, but it's quite technical. That is require a lot of prerequisite knowledge that you need to like understand the key terms, like what is ADF, what is the augmented decay Fuller, and you need to understand the math behind, so that only that makes sense. Even though till now, because our AUM is around 70 million, but our approach is like still quite like using time series data and try to use common sense logic and take advantage of the available data from market like open interest, and try to target the liquidity from the markets and make it into strategies. I will try to understand more about how you compare like logic-driven strategies or statistical-driven strategy. What is the difference, and what you find that which kind of strategies is like more powerful in your view?
Just to clarify, you are comparing discretionary versus algorithmic strategies?
No. It's still systematic trading strategies. It's also fully executed by code. But the difference is, let's say I make it an example. I will try to target like the liquidations from the market, because I'm trading perpetuals. So perpetuals that is leverage. So whenever there's like people like trading with high leverage, are more likely they will being stop out and being squeezed out. So this is kind of liquidity target that we're trying to track, and try to take advantage on it and trade based on this angle. So it's not about a lot of statistics, like a lot of like professional terms you need to understand. It's just like based on our backtest, we use this logic, we write it as a trading logic, use it with a proper model, and we try to backtest it, in-out sampling, avoid overfitting and things like that. And after all the testing procedure, then we will go for a live test. And if running smooth, then we will scale it in. So this is our approach on running the quant strategies in the crypto world.
Yeah, I think that what you described is definitely part of an algorithmic trading paradigm. Algorithmic trading does not necessarily involve any data-driven prediction. What you describe is what we oftentimes call causal models. You decided that there's a cause for certain market movement at certain time under certain circumstance, and you create a trading strategy to capture the effect. The cause might be the market will go up at this time. Well, you buy ahead of time. The cause might indicate that the market will go sideways during this period. You might want to short an option, and so on and so forth. So these are what we call causal strategies, and they often do not involve a lot of statistics or predictive algorithm, and that is perfectly fine. And that doesn't mean that math cannot add value to it. You can, for example, use math to decide how to optimize the exact execution time. You might want to use math to see if there are other factors that might be that you might incorporate to enhance the trading strategy or reduce the risk of the trading strategy and so forth. So math can always find its way in, because math is the universal language of the universe. You can't avoid it. But that does not mean that your the basic strategy need to be heavily formulated in any sort of mathematical manner.
If you want to suggest for beginners that just step into the quant world, what would you suggest him to start exploring in terms of mathematics that is like very practical and useful to start off?
Yes, if one has to use math, I think that there are essentially just two kinds that are very basic math that, I'd say maybe three kinds, three kinds now that I think about it. One is probability and statistics. Obviously, you have to understand that, things in finance, they are not predetermined that they have to happen. Maybe likely to happen, and if it happened, it does not necessarily go from 0 to 1. It could be you go from 0 to 0.2, it could be going from 0 to 0.7. You have to understand how to model the uncertainty on the outcome using a probability distribution. And you have to be able to model a probability distribution. Is it a Gaussian distribution? Well, it might be suitable for returns, but Gaussian distribution doesn't work at all for price, for example. And even for returns, you have to decide whether you are computing return using net returns or log returns, because net return also cannot be modeled by Gaussian distribution. So you have to have a fairly decent sense of what basic probability theory, basic statistics. I think that is really the most crucial.
So just now you mentioned about the exact return and also versus about the log returns. Actually, this quite make us struggle when we just step into the market, because we try to understand why in your book you are trying to use log return to do the model. Of course, now we are understanding about it, but maybe you can share about this to our audience. Yeah, they're also reading about a lot of quant materials. They are using log pricing.
Yeah, so there are two kinds of returns, and the kind that most people are familiar with is called net return. Essentially, the percent return. So, what's today's price? What's yesterday's price? Take the ratio of today's price divided by yesterday's price minus 1. That's a net return. My Google stock go up 10%. Typically, that's 10% means today's price is higher than yesterday's price by 10%. However, the problem with net return is that it cannot possibly, even in theory, has a Gaussian distribution. And it's very easy to know why. Well, net return can never be smaller than negative 100%. By definition, it just can't. You just look at the formula for net return, it's bounded below by minus 1. So Gaussian distribution obviously has to go from minus infinity to plus infinity. So you cannot use a Gaussian distribution to model net return. But log return is a different matter. Log return is less familiar, but it is easy to also define. Log return is simply the log of today's price minus the log of yesterday's price. Very simple. But this log return happened to go from minus infinity to infinity. It has a symmetric distribution around 0. And therefore, it is a very good variable to model by a Gaussian distribution. So that's that's a key fact that if you are interested in modeling returns to know about.
For the log return, right, is it like heavily used in statistical arbitrage, right, if I'm not wrong?
If you are using, if you are applying probability theory to model statistical arbitrage, yes, you would use log return. But of course, statistical arbitrage oftentimes is as simple as ranking stocks. Nobody actually care what the returns are. Is it computed log return or net return? Is it Gaussian? Is it t-distribution? Is it whatever weird distribution that they obey? Actually, sometimes you don't have to care. Arbitrage is only is essentially a matter of ranking the stocks in their increasing order of return, no matter what the distribution is. So that's the beauty sometimes of arbitrage, is that it is robust against any distribution assumption. That's what we want, because oftentimes the distribution might change over time. Today it might be have this mean and this standard deviation. Tomorrow will be a different mean and different standard deviation. You cannot assume that the distribution of returns remain constant over time. And so if your trading strategy depends crucially on this stationarity of the distribution, it may not be robust. Whereas statistical arbitrage oftentimes is robust against this drift of distributional drift, because it only rely on ranking. As long as the rank is the same, it's going to work. And so it is actually more robust than other, more sophisticated algorithms.
And also, next question is like, how that you manage, because I'm not sure how you structure your capital management company. I assume there's different department. And if this is the case, which kind of approach that you are, those are like most heavily used? Like maybe it's like statistical arbitrage, or it's just trading indexes using like momentum strategies or mean reversion strategies, or doing like portfolio cross-sectionals, trading, rebalancing portfolio and things like that, or carry trades. So maybe you can share about how you like allocate different resources and capital into all these kind of different approach.
If we are talking about the fund that I founded, QTS Capital, we are a CTA CPO, so we focus on futures, primarily futures-driven strategies. And so for futures, most often it's directional trading. Okay. There's not a lot of arbitrage that you can do in futures, except for maybe calendar spread. It's possible. But in Predict Now, which is a sort of fintech company, we apply machine learning to basically any trading strategy, and the things that we work on it oftentimes involve a equity portfolio of many components. So I wouldn't say that so that our different business have different focus on different strategies.
Okay, I understand. So from what I heard from you is that you are quite heavily using machine learning tools to derive trading strategies, because we do also try using machine learning, but eventually our portfolio is like around only 10% of the alpha is driven by machine learning. The problem that we find that it's quite easy to overfit, because it's a non-linear model mostly. So maybe you can share about like how you deal with this kind of hyperparameter tuning and avoid overfitting. And of course, all those kind of in-out sampling is the basics one. Maybe you can share about the a bit advanced that you find that during your path of doing machine learning research, that you find out that it's quite interesting for people to know in advance.
So the traditional type of machine learning that asset managers are familiar with can be called, or is called, discriminative learning, or some people simply call it supervised learning. The objective is to build a conditional probability of outcome, Y, let's say. The Y is the outcome. It could be a continuous variable like a future return, or it could be a discrete variable like is the return positive or negative. So Y is what we want to predict. And typically we want to predict Y given a set of predictors or features X. Now X, let's say in the context of Y being the tomorrow S&P 500 return, the return of S&P 500 index tomorrow. That's the Y, we want to predict that. And the predictors could be, maybe previous day's return, maybe previous 3 months volatility, or maybe it's conditioned on whether the Fed increase interest rate or decrease interest rate, or maybe it could be predicated on whether the inflation report is above or below expectation. You get a lot of predictors, right? And the problem with discriminative trading learning is that the amount of data, given all these circumstances, all these predictors are, as you pointed out, very limited. How many times is there, that a Fed had an interest rate increase? Maybe in the past 10 years, 10 times, let's say every month they have one, and then, you get 120. After 10 years, they do get 120 samples. So that's hardly, sufficient for any sophisticated model. Maybe you could use 120 to fit a linear model. Yeah, pretty good.
Yeah.
Fit a straight line. But hey, if you want to use it to fit a random forest model, or even, God forbid, a deep learning model, you could just forget about it. So yes, that would be a case of overfitting, and that's why many practitioners have struggled to use machine learning to make any profitable prediction because of this data scarcity problem. However, since in the last few years, since the advent of generative AI, some people call it, as one of the applications of generative AI is large language model, which is perhaps more familiar, to people, ChatGPT, Grok or whatever. But the general methodology of generative AI is much broader than just simply applying to language. You can apply to anything. Particularly, you can apply to returns, for example. The point of view of generative AI is not completely, but drastically different from discriminative AI. The point of view of generative AI is that we want to build a probabilistic model of all the data that you have first, before deciding to build this conditional probability of P of Y given X. In particular, you want to build a probability model of P of X. So what does that mean? Well, I wanted to know the probability of the return, regardless of whether there is going to be a Fed announcement. I want to build a probability of the Fed announcement being, increase or decrease. I want to build a probabilistic model of the weather being hot or cold tomorrow. So these are unconditional probabilities, and there are abundant data about that. You can build a model on the Fed decision, you can build a model on the weather, you can build a model on just price years. And after you pre-train this model on this P of X, which you can build using maybe 100 years of data, because we are not trying to predict anything. I'm just trying to build a model on the data. Then you can fine-tune this model using a supervised learning framework. Now you can build a P of Y given X. But this model is a fine-tuned version of P of X. It is what people call semi-supervised learning. Okay. You build a model unsupervised on the vast amount of features, and then you build a supervised learning model and a small number of data, maybe 10 years of data, 120 data points or something like that. That's called semi-supervised learning. And in other contexts, for example, in image recognition, it was shown to be a very powerful technique. For example, I just recently read the paper to say that, you think that, to discriminate between a cat image or dog image, you need to train from maybe tens of thousands of images, right? Not true. You might need tens of thousands of images, but they don't need to be labeled dog and cat. You just show them pictures of dogs and cats, but without labels. And you build a image probability, P of X, of images. But once you build that, you only need a very small number of label examples. Oh, this picture is dog, this picture is cat. And then build a supervised learning model on this very limited data. And then you will be successful. You don't need a lot of label data. So that is what is called semi-supervised learning. It is a very economical in terms of labeling. And that is the power of generative AI. And that, I think, is a framework that can be very usefully applied to financial model.
Okay. Oh, very interesting. And when just now you're explaining the concept, right, I think about a company called Scale AI. I'm not sure whether there is the connection between it, because just now you mentioned that you are letting the machine learning, letting the machines to try to study the patterns and try to discriminate and try to differentiate different kind of, I would say, clustering. I'm not sure this word is suitable to use it in this case scenario. Then only after that you're using a minimal effort to do the labeling. Am I right for this?
Yeah. Well, it's very interesting that you mentioned Scale AI. Obviously, the main business of Scale AI is labeling. So, of course, you have $100 million to spend. You can hire Scale AI to label your data, and you have a lot of label data. Nothing can be better than that. Great. The problem is when you don't have a lot of label data and you don't have the money to hire Scale AI to build this label data, you can try semi-supervised learning. And in the case of finance, the fact is that scale AI cannot help you to make more labeled data because it's just the nature of the data. It's nothing you can do about it that is limited.
So just curious about that. Just now you have mentioned the whole workflow of the semi-supervised. How long have you been working or researching on this path approach? Is it already like a long period of time? And is it have like positive feedback of using this approach to do the daily trading basis?
I wouldn't call myself an expert on generative AI and much less semi-supervised learning, I confess. So I am myself new to generative AI. I started to really get into generative AI about a year ago when I'm researching the book together with my co-author Hamlet Medina. Now Hamlet is the true expert in Gen AI. He may not be an expert in finance. I am the expert in finance. He is the expert in Gen AI. And I think the reason we write that book together is that I want to learn from him, what Gen AI is useful for finance. And I'm glad that we wrote this book because I learned a lot from him. And beyond this book, I have read a lot about different papers as part of the research for the book. I'm now, I would say that I have a much better understanding of the power of generative AI compared to a year ago. But I still wouldn't call myself an expert. So we are actively pursuing research in that area, but certainly not, I can say that we are advertised expert and very fluent in applying this technique.
Because you are choosing this, you're trying to work it on this approach with devotions basically. How you balance like the way that you are really familiarized, like all the thing that you have done in the past previously, like all the one you are more familiarized, and comparing that you are trying to explore basically a new field that you are not very familiar with it. So how you balance that? Because the thing that you familiarize, you are more confident that you can make returns out of it more consistently, and you can know every reason behind and you can do the adjustment. But because just now you mentioned the machine learning approach, I think it's still quite like a black box model. I'm not sure that how you face this kind of like uncertainty, I would say. Yeah.
Well, I mean, like every other hedge fund, you cannot assume that the strategy that are currently profitable will remain profitable forever. There's always alpha decay due to competitive pressure, regime change, and so forth. So, I don't think that this compromise is, unique to us, that we are trading strategies that have known to be profitable, but we are also exploring new techniques to discover new trading strategies. Every hedge fund is really in a constant state of innovation, just like a tech company. Okay. I mean, I shouldn't say every hedge fund, I should say every quant fund at least.
And since this is a new field and you're also like working on, how do you allocate the resources on these two, like the old and the new? Or right now you are just making the old approach that some of your team already can handle for you. So you are like 80% going to try to explore in this field, and because maybe you are trying to stand ahead at these new techniques or new technologies, so that maybe other people in the market are still yet to use this approach to make alphas from the markets.
Well, I would say that roughly speaking it's 50-50. 50% of the time you want to improve your old strategy, and 50% of the time you want to innovate, find new strategies. So, but even for old strategies, it does not mean that the latest and greatest machine learning technique are useless. A lot of the techniques the latest AI technique can be applied to improving an existing strategy. So that's not really a tension there.
Okay, I understand. And just now you have mentioned about regime shift. How you can share more about like if you have alpha strategies and you are trying to like optimize more returns from the alphas, how to tackle these questions or this problem from your perspective? How to understand regime shift in the right concept?
Oh, you mean how to discover alpha?
Okay, example. Now I have alpha running, but from time to time there's a period like maybe the regime factor is this alpha is very good. It's very making money during like high volatility regime, and it's really not a profiting time period when there's volatility is low, things like that. So, but it's not every alpha that is so clear, it's like so obvious is volatility is the regime factors. So if I want to have a more complete concept on how to understand each of the alpha characteristics and apply with the correct regime factors or predictors.
Yeah, so we attack this problem using a concept we call corrective AI. It's not our invention, really. We just invented the name. But another prominent quant, Marcus Prado, had originally called meta labeling. But we thought the corrective AI might be easier for people to understand. And the idea is that you might have a causal strategy that you created, and like you said, under certain circumstance, and we don't know exactly what, it has a drawdown. And the goal of the corrective AI is to try to understand when, or predict even, when this strategy might undergo a drawdown. Now, the original causal strategy typically are using very few factors. You might use just a previous day return. You might just use if the Fed increase or decrease interest rate, or some small number of factors to build. That's typical of causal model. But the machine learning model, however, can take into account vastly more variables or factors, risk factors that might affect the strategy. For example, we engineered over 600 of these factors internally and use them to decide to throw in the machine learning model to see if we can use this risk factor to explain the drawdown of a strategy. To be very precise, we wanted to predict the probability that this strategy will be profitable, given this 600 plus input features. And based on that probability, you can adjust the allocation or the leverage of your strategy accordingly. Or you might even decide to shut down the strategy until the probability of profit improves.
And so you mentioned about two keywords, allocation and shutdown of the alpha. So maybe we start from the shutdown portions. So when you mentioned alpha decay and when to decide to do the shutdown of the alpha, like what is your checklist or what is your signaling when this happens and you will be considering you want to shut down, or maybe like back it in the backup list and try to observe more. Yeah, so how you deal with this kind of like decision making, because this, of course you can do it with a model, but the model is still based on your thought process. So how you structures this kind of qualitative considerations?
Well, I would say that we are trying to make this as systematic as possible without human judgment. That's the whole point of corrective AI. Because before we apply the corrective AI methodology, there's always human judgment involved. It's like, the strategy look like is not working. Why? Because maybe the cost is no longer there. But it's oftentimes uncertain. Maybe the cost is not there now, but what if it come back next month? How do you know that? So we try to systematize this practice by applying corrective AI. And the beauty about corrective AI is that we produce a probability that the strategy is going to be profitable or not. And you can calibrate, therefore, using this probability, what is called the bet sizing curve. You can say, well, if the probability is high, I bet more money. If the probability is low, I bet less money, or maybe zero amount of money. And so, well, what is this bet sizing curve? Now, you can say that, well, bet sizing curve could be some kind of a sigmoid curve. It could be in the limit of a very steep transition. It could become a step curve, a step function. So that way, you will have a systematic way of deciding when to shut down, because it is all determined by the bet sizing curve. And you have already optimized that based on past episodes. Now, that is, of course, assuming that your probabilistic model, the corrective AI model is right, and that there's no and that it captures all the regimes, so to speak. If you are in a totally new environment where even the machine learning model is not capturing some of the risk factors, of course, all bets are off. There's no guarantee that our 600 plus variables capture all aspects of the risk factors or regimes, but hey, it's still better than a subjective sit of the pants sort of decision.
Okay, understand. Alright, very very interesting sharing, and this also give me some insights. Thank you a lot. And just now I mentioned about the corrective AI is you mentioned that you have 600 over features. And is it the more of the number of the feature is better, or maybe there's optimal numbers? So from time to time you are trying to eliminate some of the features also to maintain the stability of the model. Yeah.
I'm sorry, from time to time, what do we do?
Do you like eliminate because you are trying to maintain a healthy size of the features, because maybe too much of the features maybe will like is like overfitting or things like that?
Oh, I see. So you're concerned about too many factors. Well,
Yeah.
there are many techniques in machine learning to pick what are the important factors. Traditionally, for example, you can use techniques such as MDA or LIME or SHARP to score these factors. These are established feature selection techniques that let you exclude certain factors that seems redundant or powerless, to no predictive power. But in the last decade, let me say, with the advent of deep learning and also the invention of the transformer technology, I wrote a series of blog posts about this very technique. So, I encourage the reader to check out our new blog post. The transformer technique is essentially a factor weighting scheme. You can have as many factors as you want, but after you apply this transformer technology, you will find that these factors are weighted. And it's not just weighted, but it is kind of combined in a merged in some optimal manner. And when you say optimal, it is even more amazing is that it doesn't involve necessarily supervised learning. It could be also an unsupervised learning process. So you have already created this factor weighting without necessarily having it to predict something. And that is the power of the modern generative AI, is that feature selection, feature weighting is a big part of it.
All right, very interesting. And go back to the questions that just now you also mentioned that you use the Corrective AI to do the adjustment of the bet sizing. So I think bet sizing is also a big topic and also the billion dollar questions. Yeah, so how you view bet sizing optimization? Is it like a very important aspect that you are looking heavily on it? Or it's like, of course, alpha is the most important, we should spend more time on discovering more alphas. So how is your view on it?
Well, obviously, if you find an alpha that has a very high Sharpe ratio, it indicates that your strategy is immune to many systematic risk factors. And if you have a Sharpe ratio of 3, for example, it's hardly worthwhile to apply AI as a risk management, because it can't do any better. There's no risk factor to capture. There are, of course, idiosyncratic risks, but those risks nobody can predict. For example, maybe there's a nuclear disaster. Maybe there's a assassination. Nobody can predict it. So those things are beyond the reach of AI anyway. So I don't think it's you have to border it. So yeah, certainly if you can find an alpha that has high Sharpe ratio, go for it. That's the most important thing. But when you are when you have exhausted your alpha, let's say you already have a few high Sharpe ratio strategy, but you still want to diversify or increase your capacity, and you can't find another strategy that has Sharpe ratio 3, well, then you can definitely go and develop a strategy that has Sharpe ratio of 1 to start with, and then apply machine learning to eliminate risk from that strategy. So that is really an approach that you take when you have no readily available high Sharpe strategy.
Okay, very insightful sharing. Thanks again. In your whole career on the quant trading firm or as an individual traders, like which of the market event, or like maybe it's your big losing days or losing years? Because from this kind of painful experience, if you have, I think there's the most lesson learned that they can be shared to our audience.
Yeah, well, I think it's a common lesson, common to even people who won Nobel Prize in economics, and I'm talking about
LCTM.
The idea is that you are, if your profit is based on a statistical relationship, there's no guarantee that statistical relationship will remain forever true. Okay, even though it might be true in your backtest or in live trading for 3 years, it doesn't mean that on the 4th year it will remain to be true. That's a insight that I've learned myself painfully, as well as from other painful episodes such as LTCM. But what's the corollary? The corollary is that one should be very careful in applying too much leverage. Even if theoretically, people heard about the Kelly formula, and I've used the Kelly formula. I've written about the Kelly formula, and the Kelly formula is that, well, your leverage should be equal to the return divided by the variance. And we say, well, but I have a Sharpe ratio that is variance of it's like almost no variance because it's always profitable for the last 3 years. shouldn't the leverage be infinity? Well, the problem with that is that, it might have a variance of almost zero in the last 3 years, but it doesn't mean that in the fourth year it's going to happen. So it's very difficult to estimate the variance correctly, especially for the future, predict the variance in the future. And therefore, your carry leverage you should remember that it is simply a theoretical formula. It does not necessarily conform to reality in the future, and so you have to be very cautious in applying that.
Okay, so do you arbitrarily set the leverage, or you still will refer to the value that you're using the return divided by the variance? Yeah, and how you refer to it? Of course,
you can apply obviously you can apply a technique called CPPI, or what I wrote about in the book that you mentioned, the algorithmic trading. Is called constant proportion portfolio insurance. Essentially, you have to assume that if you are trading a certain statistical relationship and you have a high leverage, you have to be prepared that all that money can be lost 100%. And yet you still have enough capital to run some other strategy after that.
Okay. Very good reminder. And just now I mentioned about the black swan. Okay, maybe that's an outlier event that's not in the scope of your all the data, and your AI model cannot discover this kind of event happen. Do you have any kind of precautions or the handling method that you encourage people to do? Because since you mentioned you cannot fully believe in the model as well.
Well, ideally, if your portfolio can be hedged, for example, you're trading a long-only strategy, well, if you can buy a put option on the index, that would eliminate a lot of the downside risk. And so, if it can be hedged, go ahead and pay for some insurance. If not, then you have to diversify. So you're hoping that strategy A will benefit when the earth is the economy is come crashing down, but strategy B will be going opposite. So you're trying to run anti-correlated strategy or diversified strategy. That's another way to handle this kind of risk. But beyond that, it's just to maintain a attitude that whatever statistical relationship you learn can be broken.
So last questions, and I think this one will be need to be a bit inspirational. Maybe you can share about your life story especially in your quant careers, how you change your perspective and how you understand the market differently over time, and what of the moral of the story that you can bring along to our audience and that you think is very important, or maybe it's mindset, or maybe it's things that you have faced, the challenges, or maybe your company human capital management, things like that, things that you think is worth reminding.
Well, I think the main lesson is that you have to put your own money at risk before you can learn anything in the market. You can read at 100 papers, do 100,000 back tests, and give lectures and write books. None of that is of any use to making sure that your strategy is profitable unless you risk your own money.
Okay, maybe we can have 3. Just now I mentioned 1, so another 2 suggestions for our youngsters. Yeah.
I would say that that's the second suggestion is that don't believe everything that you read. A lot of people ask me, hey, I want to pay you X dollar, and you tell me about a profitable strategy. I say, well, you can never afford to pay enough for a profitable strategy. Even I don't know if the strategy will be profitable after I give it to you.
Okay.
So every strategy has to be reinvented by the trader herself. You cannot read it from someone and just expect it to work as is. It is not going to the supermarket and buy a sandwich or a watermelon and you just go and cut it and eat it. You can't. There's no off-the-shelf strategy that you can learn from. Every strategy has to be transformed by your own intellect and experience and pain and blood and sweat. That's the only way.
Very true.
Yes.
Very true. Okay.
All right. So do you have the last one, or that's all?
No, I think those 2 are the key. But the rest of it is like, you should work hard and learn statistics, learn machine learning. Well, that's part of the course. Hardly need me to tell people to do that.
Okay, sorry. Last questions. Okay, just curious out of questions. How do you view crypto markets? Do you personally involve and trying to involve? And if not, why is the reasons that it's not the time for you to explore in the crypto market yet?
Oh, I have nothing against crypto market. We have developed trading strategy on crypto market. The only problem is that since we are a regulated entity, the regulatory scrutiny of trading crypto has always been quite high. And so, we have to proceed especially carefully in that respect.
Alright, so I think that's the time for it. So very appreciate for your time and sharing a fruitful insight for our audience. So hopefully if the response for our audience is very good, maybe we have a second talks in very short futures. Yeah, so thanks again, Dr. Chen. And remember, if you guys want to follow him, you are on Twitter, right? Twitter, and also you can follow his page and website. I will put the link down below, so you can study more about especially the new books of generative AI. Definitely you want to stay up to date on the market. Yeah, so I think that's all. So if you like the content, make sure you comment and like and subscribe and share to your friends. Alright, so this is our podcast for today. Thanks for everyone. Thank you.
Thank you, Anson. My pleasure to be here.
Alright, thanks a lot.